Hey, good morning once again, options traders, and welcome back, everyone. You often hear me make the analogy for call options that they are very much like a pizza coupon. And there's a lot of parallels that you can make that helps traders to understand really what's happening whenever you buy a call option. But I also talk about a strategy a lot called the stock replacement strategy, which is where we go super deep in the money with a call option to make it behave like shares of stock. And unfortunately, traders still shy away from this very powerful strategy because they think they're spending a lot on the option, and they're simply not. And one of the best ways to understand why you're not is to see call options in a different light. Let's take a look at call options as layaway plans. And before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start off. Let's say it's maybe the holiday season. You go out shopping and you spend $1,000 on gifts. Now, many stores will offer layaway plans. And just because it offers a layaway plan doesn't mean that it's only for people that can't afford to check out and pay the full price. Sometimes it's because you need a storage space. You don't want the kids to find the gifts, let's say. It can be a very big benefit. So let's say that this store offers a layaway plan, but as a good faith deposit, they require a 20% down payment. So because you've purchased $1,000 worth of stuff, 20% would be 200 bucks. All right, well now let's answer a question. Is it fair to say that the store charged you 200 bucks for the layaway plan? Is it fair for you to go out and say, "Man, that was really an expensive layaway plan. It was 200 bucks." Well, not at all. It was a down payment on the very things you were going to buy. And we can see it by looking at the $1,000 total price. That was your total value of your shopping cart. If you put $200 down, and when you go back to pick up the goods, you have an $800 balance. Notice that it's less. It's not 1,000, it's only 800 bucks. We add these two up, and there is the 1,000 total. So if you put $200 down and go back and pay $800, you have paid the identical amount, 1,000 bucks, as if you had checked out all at once and paid the $1,000 up front. So now that you see it in this light, let's answer the question. How much did the layaway plan cost? It cost zero. It did not cost 200 bucks, even though that's kind of what it might feel like because you had to shell out 200 bucks to take advantage of this layaway plan. That was just a down payment on the things that you were going to buy anyway. And that's why we would say the layaway plan by itself really cost nothing. All right, straightforward enough. Let's change the rules a little bit. Let's say that the store requires the same 20% down payment, but now they have some type of a little fee, whether it's for a convenience fee or the maintenance fee of it, but it's a flat $10 fee. Okay, now how much did the layaway plan cost? Well, let's go back. Remember, the total amount in the shopping cart was 1,000 bucks. They require 20% down or 200 bucks plus a $10 fee plus when you go back to pick it up, it's going to be the $800 balance. And so if you use the layaway plan, you're now going to spend 200 plus 10 plus 800 or 1,010. Now notice that this number is a little bit bigger than the alternative choice of checking out all at once, which would have cost 1,000 bucks. How much more? $10 more. So now if somebody says, how much did the layaway plan cost? In other words, how much over and above were you spending to take choice 2 instead of choice 1? The answer is 10 bucks. It's this $10 fee that we would say is the cost of the layaway plan. It's not $200 and it's not $210. Even though when you left the store and put this stuff on layaway, you did have to give them 210 bucks. But the layaway plan was simply 10. All right, now that we've gone through that analogy, watch how it applies when we're looking at deep in the money options. Okay, so here's a screenshot. At the time, the S&P 500 was trading for about 474. This is the SPY. And we're going to look at roughly a year out, 366 days. And let's say that we want this 385 strike. And I'm picking it because it has a delta. It's a little bit high out here, but usually in an 80 to 85 range. Sometimes when we go further out, we have to push these deltas a little higher. But for right now, just take it that this is what we're choosing as our stock replacement option. Now, the intrinsic value on this is, let's call it 89 bucks. So if you put $89 down and a year later decide to exercise and pay $385, how much did you pay in total? You paid $474, exactly the price of the underlying. So we have to say that this $89 figure out here has nothing to do with the option. You could either pay $474 today, or you could pay $89 and exercise a year later and pay $385 and pay $474 in a year in total, same price. So this $89 has nothing to do with the option. It has nothing to do with the right to walk away. But just like the second example with our layaway plan where the store charged you $10, no trader is going to give you this deal, give you the right to walk away from it for nothing. There's risk in this. There's risk in holding it, and that's where the extrinsic value is coming from. And we can see that it's roughly $21. All right, so if we pay $109.81 total, that's the mark. That's the total we would have to pay for this $385 call. $109.81. If we exercise it in 1 year and pay an additional $385, now the total that we've paid is $494.81. And if we compare that figure to the current price of $474, now we're about $20 off. Where is this additional premium coming from? Well, it's coming from right here, the extrinsic value. That's the price of the layaway plan. Just like in our example, this is like the $10 fee. It is not the $109.81 price. It's not the $89 of intrinsic value. This has nothing to do with the option. It's the $21. Now, of course, as I've talked about in other videos, we can break this down further because this also includes a cost of carry. Interest rates aren't zero, and so if you are asking somebody to float this $385 for a year, then we know that the true option cost is going to be reflected in the put at about $650. Let's just call it roughly $7. Therefore, the additional 14 is the cost of carry. In other words, yes, it looks like a really expensive option at $21, but 14 of that is from the cost of carry. Because theoretically, by not buying the stock for $474, you are only paying $109.81, and you're getting to float $385. And that is theoretically coming back to you in interest because you didn't have to pay for this in full. And that's going to work out to be about $14. That's why there's about a $14 difference between the extrinsic value on the call and the extrinsic value on the put. So if we really want to break it down, you're paying about $6.57, maybe $6.60 for the right to walk away over a year's time. And you divide that out, and it's a really cheap insurance policy. However, if you're paying this $109.81, let's just say it's roughly $110, instead of $474, it's about 23% of the underlying price. You're getting about 4-to-1 leverage. You're paying 1/4 of the price, and yet it's behaving about like stock because it has a very high delta. We've got this 89 delta right here. And what are we paying for the right to walk away? Just under $7. So again, when traders look at this, they say, gosh, I got to pay $110. That's going to decay like crazy because it's a very expensive option. No, your time decay is right here, $21. So your time decay curve just looks like this. You've got a $110 option that if we hold the stock price the same, it's just going to lose about $20. Technically 21, but in round terms, it's going to fall about $20. That's it. And so if we look at the risk graph, yes, it looks like you're spending a lot for the call, In total, it was 110 bucks. But remember that the underlying is up here at 474. So we've got this very long range. You can see where the red and black lines kind of line up. That's behaving just like stock through most of the range. However, if the stock falls even down to here, you're still going to have a very high delta. But if it falls down to the strike or below, we have the right to walk away. And for that right, it's going to cost us about 21 bucks. So there's an option pricing principle that you need to understand. I've talked about it before, and that is if the stock is 100, and if there were such a thing as a zero strike call with unlimited days to expiration, that call option would trade for 100 bucks. So it would be completely unfair to say that it's a very expensive call option. In that case, the call option's price is zero. There's no value to it at all for the right to walk away, and that's because your floor is all the way down to zero. If the stock falls to zero and you want the right to walk away, there's not much else it can do to fall below zero. So just remember that the intrinsic value has nothing to do with the option. So let's go back to our quote board. Let's go even further in the money. Let's look at the 255 strike. Now that's going to cost you 228.70. All right, so if you paid 228.70 and you exercised for 255 in basically a year, your total cost is 483.70. We compare that to the current price of 474.64. How much over are we paying? And that's roughly $10 more, which we're seeing right here in the extrinsic value. Now again, we can back out the cost of carry. We've got the 255 strike, so we don't have as high of a strike price as we had last time. It's not going to be as much. So we look at the corresponding put right here, trading for about $1.30. And so if we back that out of this figure, you're paying about $8.40 for the cost of carry, which theoretically is coming back to you because you're not having to spend the 255 today. You get to float that for 366 days. And yet, traders will shy away from this. They'll say, there's no way I'm spending 228 bucks on an option. You're not. That's just intrinsic value. It's the price you are going to pay anyway. And yet again, if we look at this 228 figure combined with the 255 strike, if we exercise, that's what's bringing us up to this 483.70 price. So it's again roughly $10 more. But if we look at the 228 figure relative to the current 474 price, it's less than 50%. So in the stock market, you could go on margin and get 2 to 1 or at 50%, but you also pay probably 14% interest rates, and you also face the risk of a margin call. Not so here. And yet, what are you paying for that? $1.30. That's it. In fact, it's even better because you have the right to walk away at 255. You buy the shares on margin, you don't. You could ride that all the way down to zero. So the point to see is that when you really look at this in detail, you'll see it is not an expensive option. In fact, here's our current risk graph for this 255 strike. Here's the current stock price at 474. Look how long that range is for those positive deltas, roughly at delta 1. It's virtually the entire segment, and that's why this is behaving far more like shares of stock. The chances for it to fall down to this 255 strike is pretty close to zero, which is why the market's not charging you much for the insurance policy. Remember, it was about $1.30. And yet, we can afford to have that stock fall all the way down to here and still be behaving like shares of stock. So once you understand that a call option can be viewed as a layaway plan, it will help you to understand the role of the intrinsic value. That's just the amount of the down payment, the good faith deposit that you are going to have to pay anyway at some time. Got nothing to do with the option. And then there's also a potential store fee. There's a potential fee over and above that they might charge for the layaway plan. That's the role of the extrinsic value. So now that you understand that, you can devise your own strategies as a stock replacement strategy. Get the deltas high. Do you want an 80 delta? That's fine. 85 delta? 90? Pick your deltas. And you can figure out how much you're paying for the right to walk away and figure out which is best for you. And one of the easiest ways to do that is to see your call options as a layaway plan. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.